Federal Reserve has lowered interest rates, but what does it mean for mortgages? Also, what does it mean for the housing supply? What does it mean for affordability? Let's cover all those topics and more items. Let's get after it right now. Welcome to the Living in Utah channel. I'm Mike Gallagher, a local real estate agent. So when it comes to the federal fund rate and what does it mean for mortgage rates, etc., let's see what the experts are saying about some of the topics. First one, they actually say that mortgage rates might not actually drop much further right now. And there's a few reasons for that. Let's go back a little bit. Remember the COVID days? Well, during the COVID days, we actually had interest rates, mortgage rates, below 3%. It did drop below 3% for a short time period, kind of hovered in the threes for quite a while during 2020 and 2021. But then as the restrictions were being lifted and the economy started to pick back up, the Federal Reserve started raising those rates. We got as high as 8% on a fixed rate mortgage. We went from a 3% fixed rate mortgage up to about an 8% fixed rate mortgage. A significant increase. Just a prospect of possible rate cuts has already sent the mortgage rates lower, even before the Fed announced its actual decision last Wednesday. Long-term fixed rate mortgage rates are now at 6.2%. Remember I said we jumped up to about 8%. This is the lowest since February of 2023. It's also worth noting that there are other factors besides the Federal Reserve's benchmark interest rate that can influence mortgage rates. Economic conditions can be a very big driving factor. That's pretty much what we saw during COVID. It was the economic conditions that led to the really low interest rates. And what this means is that effectively the rate cuts that are announced by the Federal Reserve may already be priced in. So some banks have already lowered the rates in anticipation of the possible rate cuts. Now, Mr. Charles Doherty from Wells Fargo, he expects mortgage rates to drop marginally after the Fed cut its rate the other Wednesday. He and his colleagues forecast that the average 30-year fixed rate mortgage will be about 6.2% by the end of the year, pretty much where it is right now. He also anticipates the 30-year mortgage rate will fall closer to 5.5% by the end of 2025, still above the pre-pandemic levels, but in my opinion, if we can head down towards 5.5, that's better than going up towards 9 or 10%. They also talk about how lower mortgage rates could actually mean higher housing prices. Well, how is that, Mike? Well, when you have lower mortgage rates, it makes it easier to buy a home. Yeah, it's a given fact. But it also can lead to higher home prices. So for some people, they might be just priced out of the market if the prices keep going up. This is what we saw during COVID. So the lower mortgage rates are likely to lure more buyers back to the market, bringing in more competition for a limited supply of homes, and that's absolutely correct. There are buyers during COVID time period that missed out. They just did not have the money to go $25,000, $50,000, $100,000 above asking price. Sometimes buyers got beat out by pure cash offers. Now, these buyers are still hovering around the market looking to purchase a home. Typically, their first home. So they are probably looking at re-entering the market also. So there's going to be more competition for possibly less homes. So the experts also talk about how the dropping interest rates can lead to more housing supply problems. Key reason for the high home prices currently is the lack of housing supply. The U.S. is short millions of housing units. Supply has not kept up with demand, especially as a large millennial generation is forming households and trying to buy a home. This is a problem that we've had for about the last 5-10 years. We need to build X amount of homes every year to keep up with population growth. Has not happened. And during COVID, supply chain problems, you couldn't get wood, sometimes you couldn't get lumber, sheetrock, slowed builders down from building homes. Now, the high interest rates that we've had over the last couple of years has not helped either. Remember, most home builders have to go out and also get a loan to build a home development. And these costs have been very, very high by the time they purchase the land and the interest rates, etc., etc. It has been very expensive. Some builders have backed off their construction projects. But now that the rates have come down, we should see more builders building a few more homes. It's a little more cost effective for them to build a home nowadays. Hate to be the bearer of bad news, but we also have an affordability crisis. We've had it for a while. It's still a big problem. Lower mortgage rates can definitely bring down your monthly payment for a house. But if the prices of homes increase and increase, will you have any savings? Will you really be saving? It goes back to the inventory levels. We need more inventory, more competition would help control the prices. That's this week's video. If you have any kind of questions, by all means, reach out to me. Glad to answer anything that I can. Till the next video, take care and stay safe.